Dustin, good to see you. Today we get to talk through defining your risk tolerance and expectations for returns. The relationship between risk and return is fundamental when it comes to investing. Generally, higher returns come with higher risk, and lower risk typically means lower potential returns. So to start, Dustin, can you explain what risk tolerance is and why it's so important for investors?
Right. When we talk about risk tolerance, what we're really talking about is we're trying to determine how much volatility an investor can live with in the short term. So, if we look at the investments that tend to have the best long-term returns like stocks in the long run, oftentimes those investments also come with the highest risk of loss in the short run. So everybody wants the best long-term return that they can get. We have to balance that, however, with a portfolio and a level of risk that an investor can live with in the short run.
Mm-hmm.
And it's really important that we pay attention to this, because if that portfolio isn't aligned with a client's risk tolerance, the first time something bad happens, the first time markets sell off, a lot of investors tend to want to make decisions based on emotion that can
Right.
have some really negative impacts on our returns over time.
Really good point. So, how do you go about helping clients then define their risk tolerance?
Well, one of the things we'll do, we'll help a client complete a risk tolerance questionnaire. Now, that questionnaire alone may or may not help us really determine an accurate risk tolerance for that client. But before we even get to that questionnaire, we're going to have some conversations, and I'm going to listen intently to try to find out what's important to that client. What are they worried about? I'm going to ask about their past experiences to see what they've been comfortable with in the past, what's made them uncomfortable in the past. All of those are going to be clues to me that are going to help me really nail down that client's, an accurate representation of that client or that investor's tolerance for risk.
Mhm.
Something else that we're going to pay attention to is the investor's capacity for risk. So those are really two different things: risk tolerance and capacity for risk. We could be talking about a 30-year-old investor who has many years before he or she is going to reach retirement. So they might have the ability or a lot of capacity to take on risk. But hey, that same investor might be an investor who's just not going to sleep at night at all if they
Right.
see losses in their portfolio. So somebody could have a great deal of capacity for risk and still not have the tolerance for that risk. On the other hand, for example, I was recently working with a couple in their 70s. They've been taking on a considerable amount of risk for some time. They're pretty happy living with it. Doesn't bother them. So they've got a high risk tolerance. But, we were looking at their plan, and they're getting to the point where they want more predictable, more consistent income. And the amount of risk that they're taking on threatens that plan. So while they're comfortable with risk and they've got a high risk tolerance, they don't really have as much capacity for risk as they thought they did when they came to see me.
Mm. Now, another question. Can an investor's risk tolerance change over time? Should changes in the market affect our risk tolerance?
So both their risk tolerance and investors' risk tolerance and their capacity for risk, both of those things can and will change over time.
Okay.
Now, optimally, if we've got a portfolio, if we did a good job, that portfolio is aligned with their risk tolerance, we shouldn't be looking at making big changes to the portfolio when markets move or when they sell off. Now, having said that, when markets sell off, sometimes it will reveal to us that our risk tolerance wasn't what we thought it was. Many times when volatility is low, markets are rallying, there's not a lot to worry about. Oftentimes an investor will tell me they're really comfortable with risk. They're an
Right.
aggressive
Right.
investor. And then the markets sell off. That same investor comes back to me and says, "Hey, I'm not comfortable with this. I'm really a conservative investor." Well, we don't want to try to adjust the portfolio, with the whims of the market. So anytime that a client or an investor tells me that their risk tolerance has changed, or it's revealed that their risk tolerance has changed when markets sell off, we'll try to make adjustments to that portfolio to again align the portfolio with the client's true tolerance for risk.
Great. So, what is the role then of working with an advisor, and how does an accurate risk tolerance define both an investor and an advisor's expectations?
I think a good advisor can help in two ways. First, if they can, if we can help keep an investor or a client's portfolio closely aligned with their risk tolerance, again, we're going to do a better job at avoiding those decisions based on emotion that can hurt our long-term performance. And then the other thing that a good advisor will do oftentimes is introduce some risk management into that portfolio. So for example, when we add strategies like structured investments to a client's portfolio, what we're doing is we're transferring some of that investor's risk to other investors or other institutions. And oftentimes that can help that investor more comfortably, more easily stay invested, stick with it. And again, avoid those bad decisions based on emotion that can hurt our long-term performance.
Right, right. It all comes back to having that financial plan. So, Dustin, if somebody would like to speak with you about defining their risk tolerance and risk capacity and putting together that financial plan, how can they reach you?
They can send me a text at 830-476-2505, or they can reach out on the website to book a free chat at longlivemymoney.com.
Great. Dustin, thank you.
Thanks, Aaron.